Early human trade. Trade existed long before the concept of money, operating primarily through two main concepts, gifting and barter. The most common method was the gift economy. In this system, valuable goods and services were exchanged without any explicit agreement for immediate or future reward. This was less about direct payment and more about creating and strengthening relationships, a form of altruism. For example, in hunter-gatherer societies, sharing food acted as a safeguard against the entire community starving. The gift might not be repaid instantly, but it often led to higher social status or other social benefits for the giver. The other prehistoric method was barter, where you directly exchanged your possessions for something you perceived to have similar or greater value. For instance, you might trade a stone tool you crafted for food provided by a hunter. However, historical evidence suggests that barter was never used systematically across an entire society and played only a minor role in the actual emergence of money. History of money. The first forms of money didn't emerge for trade, they were created to manage social relationships. Early currencies were used to arrange marriages, prove paternity, seek forgiveness for crimes, or negotiate treaties. Around 9000 to 6000 BC, after the domestication of cattle and the cultivation of crops, livestock and grains became the earliest forms of money. But agricultural products take time to grow, creating a need for immediate purchasing power. This need led to the introduction of debt and credit. With the rise of cities in Mesopotamia, a new system appeared, asset-backed credit. Farmers deposited grain in temples and received clay tokens as receipts. These tokens could then be used to pay fees or debts. As trade expanded, especially with foreigners, money that carried value independently became necessary. Gold and silver emerged as trusted commodities. Grain continued to measure value and labor locally, while silver was used for taxes and long-distance trade. The stability of this system was enforced by local rulers and backed by temples, which maintained fixed rates between barley and silver. This was the true beginning of large-scale accounting and managing an entire economy. This system marked the real start of organized money and economic management. Age of Bronze. Age of Bronze marked the formalization of money in society and law. Around 2150 BC, the Mesopotamian shekel was recorded, functioning as both a unit of weight and a form of currency. The Babylonians led the way in creating a sophisticated financial system. Their city-states developed detailed rules for debt, legal contracts, business practices, and private property. This effort culminated in the Code of Hammurabi, one of the best-preserved ancient law codes, which clearly defined the role of money in civil society. It regulated interest on debt, fines for crimes, and monetary compensation for various offenses. Metals quickly proved superior to commodities like cattle or salt because they were durable, portable, and easily divisible. Gold emerged as an early form of money, with evidence from the 4th millennium BC showing Egyptians using gold bars of specific weight as a medium of exchange. This period established the foundation of money as a stable, regulated, and essential part of civilization. Origin of coins. The transition from weighed metal to standardized coins happened independently in several regions, including India, China, and the cities around the Aegean Sea. Early coins were produced differently across these regions. In the Aegean, coins were heated and hammered with an insignia. In India, they were punched metal discs. In China, coins were cast in bronze with holes in the center. By the 5th century BC, the Greeks had developed a full economy centered around minting coins, using silver mined in southern Attica and Samothrace with a massive workforce of slaves. The system evolved further under the Roman Empire. The origin of modern financial language is tied to the Roman temple of Moneta, which housed Rome's mint for 4 centuries. The goddess Moneta's name eventually became the source of the English words money and mint, shaping how we think about currency today. Ancient Roman banks. The foundations of modern banking began in ancient Rome, where the earliest banks were often located inside temples. These banks offered services familiar to us today, charging interest on loans, exchanging money, and keeping detailed written records. To protect their wealth, Romans often stored money in multiple temples. Roman banking included specialized roles. The Argenturii were private money changers supervised by the government. They started by exchanging foreign currency for Roman money, but soon handled almost all financial transactions from stalls, shops, and the Roman Forum. The Numularii began by minting and testing coins, but by the 2nd century CE, they also gave loans, accepted deposits, and managed bank accounts. Despite these advances, the system lacked regulation. Banks relied entirely on trust, leaving clients vulnerable to financial crises. It would take another 1,000 years before the world saw its first fully regulated currency system. Medieval money and trade. The world's first seriously standardized currency appeared in 800 AD under Charlemagne, the Holy Roman Emperor. One of his key reforms was the introduction of a standard coin, the silver penny, which became the primary denomination across much of Western Europe. However, without proper oversight from local authorities like bishops, cities, or feudal lords, coin debasement quickly became a problem. The silver content varied widely. Coins in Venice contained only 0.05 grams, while coins in England held 1.3 grams, making large-scale trade difficult. By the mid-13th century, larger coins were introduced to meet growing economic needs. In England, 12 pennies made a shilling and 20 shillings made a pound. Italy became especially influential, with Florence striking the Florentine florin in the 13th century. The florin became essential for bigger transactions, including dowries, international trade, and taxes. These larger denominations reflected the expansion of economic activity beyond simple local exchanges, marking a new era in medieval commerce. Birth of banknotes. Inspired by the success of London's goldsmiths, commercial banks began issuing their own paper notes, called banknotes. These private notes circulated much like government currency today and became common in England until the Bank of England was established in 1694. In the United States, the practice continued into the 19th century, with over 5,000 different types of banknotes issued by various banks, leaving the country without a unified national currency. Banknotes were a form of representative money, promising they could be exchanged for a fixed amount of gold or silver at the issuing bank. Yet the system was unstable due to fractional reserve banking. Banks often issued far more notes than the metal they held in reserve. A sudden loss of public confidence, sparked by rumors or an economic downturn, could lead to mass redemptions. When too many people tried to exchange notes for gold at once, banks ran out, causing bankruptcy and financial chaos. This inherent fragility eventually led to private banknotes being replaced by stable, government-backed currency, laying the foundation for the modern banking system we rely on today. Goldsmiths as bankers. Following the travels of Marco Polo, the idea of paper notes slowly spread, but modern banking truly began in England. London merchants had large reserves of gold and initially stored them at the Royal Mint. That changed in 1640 when King Charles I seized private gold as a forced loan, destroying public trust. Merchants then turned to London's goldsmiths, who had secure vaults and charged a small fee for storage. For each deposit, the goldsmiths issued receipts certifying the quantity and purity of the gold. At first, only the depositor could redeem these receipts, but over time they evolved into promissory notes, legally considered loans to the goldsmith. This innovation allowed goldsmiths to use deposited funds to provide loans to others, creating the principle of fractional reserve banking. Through this system, London's goldsmiths became the first private bankers, laying the foundation for the British banking system and the global financial institutions we know today.